Hello, everybody. I'm sorry for being late because of the timing on my computer. It shows that still we didn't get 1 p.m. So it's wrong with the current timing. So that made me to go wrong, actually. Sorry for that. Actually, you've been waiting for 10 minutes in here. I hope you're all good and healthy. I'm okay today. I'm like almost recovered, but I'll be able to deliver the lecture. And would it be possible for somebody to share that the lecture started in WhatsApp group, because I'm not in the WhatsApp group and it will take that time to go through the emails. So somebody shares the info that the lecture started. Okay. Now we are left, actually last time we discussed the cash flow projection. It was the last time we did it. And the cash flow projection, we talked only about expansion and the new product types of projects. And we said there are two different methodology types that have been used, like depreciation and modified accelerated cost recovery system methodology. And today we're going to move to the different type of the cash flow projection project type, which is replacement cost, So replacement project analysis occurs when a firm or company must decide whether to replace a certain existing asset or equipment with something new or better. Of course, when you replace something with a new, the purpose to do it with, because it considered to be better in terms of some benefits, like cost saving, giving more benefits, and so on. When there is a replacement decision by a certain company, the relevant cash flows expand to consider the disposition of the replaced assets are here incremental depreciation expense that you should take into consideration. It's very important, like depreciation from the old equipment with depreciation of the new equipment that you're going to replace with actually. And incremental cash flow. Cash flows are cash flows from new and the old one. So the relevant cash, the key in here is that the relevant cash flows are those that change with replacement, okay? Here we're given some formulation, like 3 steps to calculate. We calculate outlay, we calculate cash flow, and we calculate total terminal non-operating cash flow. So this is what we do. Yes, please?
Can you make a demonstration of a screen? Because we don't see.
Oops. Thank you. The sickness affected me negatively. Okay. Just, I'm very, very sorry for that. Thank you for reminding me. Okay, let me go just from here. Can you see it now?
Yes, thank you.
Okay. Replacement project analysis, as I said, occurs when a certain firm must decide whether to replace certain existing equipment with a new one. And the purpose of doing this is to get something better in terms of getting more money, in terms of saving cost. When there is a replacement decision, the relevant cash flow expands to consider disposition of the replaced assets, incremental depreciation expenses, like you're taking the depreciation, the difference between new equipment depreciation and the old equipment depreciation, and incremental cash flows, like with the between new and the old one. So these are the 3 replacement project analysis that we do it. Actually, in the project analysis, we did it same. So first we need to determine what is your outlay. What is your investment cost? Second, you should be able to determine what is the change in network, change in cash flow, okay? This is second. And the third you calculate is terminal non-operating cash flow. Terminal non-operating cash flow. So as abbreviation, this FICINV, it stands for investment in fixed capital. This stands for, let me just write it down, for that you can just be aware of it. I think you already know it, but there's some terminologies that you don't know. So I'll put it here. FICI investment. It's fixed. It's investment in new fixed capital. Investment in new fixed capital. We have NWC, which is it's investment in net working capital. This is what we did it generally for expansion of the new product. We used to add to fixed capital investment, to investment in fixed capital, plus the investment in net working capital. And there's some formulas are given here, like SAL0, B0. So what those things mean here? So SAL0 let me just write, refers to cash proceeds or salvage value from sale of old equipment. And we have B0, which is book value of old equipment. Okay, so this is the definition. So what we do here to calculate the investment outlay for the replacement project analysis, we need to find out what is your investment in fixed capital, plus what is the investment in net working capital, minus salvage value from the old equipment or cash proceeds from the sale of the old equipment, and plus difference between the book value and the selling price. If your book value is different than the selling price, that amount should be taxed, okay? That amount should be taxed. If they're same, like it gives you 0, so you just ignore this part. And this is the same formulation, just plain out with the signs, okay? You're gonna get the same one. You're gonna get the same answer. So when you calculate second parts for replacement project analysis, the incremental value, what you do in here actually, you calculate change in cash flows. So the same structure, the income statement structure, like sales minus costs plus minus depreciation, you get the EBT, earnings before tax. But however, you take the difference, the incremental value between the old and the new one, sales from the new and the sales from the old. So we're gonna have the example that will make you to understand better. So what those things mean in here, that will make you to understand better actually. So we are giving an example in here. Suppose the maker wants to replace existing printer with a new high copier. Existing printer was purchased 10 years ago. So we purchased a certain printer for 15,000 bucks. The printer is being depreciated using straight line depreciation basis. So we're going to apply the straight line methodology with the useful life. So we purchased certain printer and the life of that printer is 15 years, okay? So if it's 15 years, the depreciation expense will be 1,000. So existing printer is not replaced, and it will have zero market value at the end of the useful life, okay? So at the end of the 15th year, we will be able to sell it for $0. So nothing we're gonna get it from sale. So it will be just exhausted, the equipment. However, if you take any decision to replace it, the new high-speed copier can be purchased for $24,000, including the freights and installation. But this copier, the new printer that you're gonna buy it for $24,000 will have only 5-year useful life. But the purpose of buying it, you bought it because you wanted to reduce the labor and the raw material usage sufficiently, so that your operational cost will be cut from 14 to 8,000. So your cut of operational, so from all this it was 14, now it's 8,000, okay? So you are actually going to save every year 6,000. Every year 6,000. This is what it means, okay? Now you're buying a new equipment, new printer to replace the existing one. The purpose of doing this is to save the money on labor and on raw material usage. But the amount you're saving is 6,000 bucks per year. It is estimated that new copier can be sold for 4,000 at the end of the 5 year. So your aim is to use this new printer for 5 years. And this new printer will be used for 5 years, and at the end you'll be able to sell it for $4,000 at the end of the 5th years, okay? This is estimated value of salvage for certain new printer. However, when it comes to the old printer, the market value currently is 2,000. Look, if you calculate it, we said we bought all the equipment for 5,000. Sorry, 15,000. 15 years. Sorry. 15 years. Straight line depreciation. So which means for 1 year, you will have depreciated your equipment equal to 1,000. Okay, but only 10 years passed. For the last 5 years remaining, we decided to replace that old equipment with the new equipment. We decided to replace old equipment with the new one. So which means that 10 years already passed, and how much value remaining, the book value?
5,000.
5,000. So 5,000 bucks remaining as depreciation amount. So for the last 5 years remaining, for each year 1,000 dedicated, so that it means. However, the market value is equal to
2,000.
2,000. So there is a loss or gain?
Lose 3,000.
So you're losing money actually in here. So this is the logic. I wanted to understand the case itself. So we're going to apply this case in the spreadsheet. We're going to use it in the spreadsheet. Now, let me just... Replacement project analysis example. We are following the company's Fed tax is 40%. The replacement considered slightly below the average risk, and net working capital will be increased by 3,000 at the time of replacement. So by IRS ruling, the new copier falls into the 3-year Makers class, okay? 3-year Makers class. So which means we're not going to use the straight line in here. We're going to use the modified accelerated cost recovery system. So project cash cost of capital is 11.5. So under this accelerated method of depreciation, we'll have the following depreciation for the equipment. In year 1, 7,920. In year 2, 10,800. In year 3, and so on. So we are asking here to compute the initial investment outlay operating cash flow over the project's life and the terminal year cash flows for the MAECOS replacement project. So then we need to determine the project should be accepted using the NPV analysis or not. So I'm starting the Excel here. Fixed capital investment, net working capital investment. And we said the fixed capital investment, the new one that we buy it, the price is 24,000. This is how much we spend the money, $24,000. Okay, this is our cost. Let me dollarize it, and let me make it bigger. Net working capital investment. Our net working capital is increased by 3,000. It increased by 3,000. What it has been said. So now in here we need to include the information about for how much we'll sell it. For how much we'll sell it. So we will apply the formulas only, guys. The formulas which are given here. Okay, this is the formulas. Let's say we are getting this formula. Okay, we apply this formula. Oops, sorry. Okay, now we'll apply only this formula. So fixed capital investment here, net working capital investment here. Now salvage value of all equipment. I mean the selling price, the cash proceeds from the selling certain old equipment, and we will be able to sell it like sell of old equipment like this. So we are selling for 2,000. It's here for 2,000. The market value, because even though the book value is 5,000, but we will not be able to sell it for 5. We will be able to sell it only for 2,000. So there is a loss of 3,000. So we are selling for 2,000. Now we're selling it. Okay, I'm gonna dollarize it again. This one. And we need to put the book value of old equipment. But this book value of old equipment should be taxed. Okay, we're gonna put it just this part. Okay, book value of old equipment, and let me call it as T times S minus B, okay, or S0 minus B0 to make it more clear. So in here I'm gonna find what is the book value, but with the tax rate, if the federal tax rate is 40%, the federal tax is 40%. So what I'm gonna do here, the book value is 5,000. The sale market value is 2,000. It's just simply 40% times 2,000 minus 3,000. Okay, so whatever the case, we have it here, we'll have it in here. I'm just pressing enter. 2,000 is the market value of that old equipment, and 3,000, sorry, not 3,000, but 5,000. Why I'm putting 5 here? 3, so 5. So 2,000 and 5,000. I'm gonna dollarize it. Okay. Now, only what you need to do is just apply this formula to calculate the investment cost. Okay, investment outlay, or investment cost, whatever word you like to call it, So fixed investment in fixed capital plus net working investment, net working capital minus the salvage value And we should add this taxed amount. We should add taxed amount, which is this one. So our total investment outlay is equal to 23,800. 23,800. Now, do you have any questions until now? Please feel free to ask. I think everything is straightforward. So far, what we have done is this. Then we move to sales and cash operating expenses. So we have sales, cash, operating expenses. We have, then we depreciation. Depreciation, okay? So from sales, look, you purchased this new equipment with the purpose to reduce the cost. But however, the sales, the number of the unit that you're producing it using this printer, in both cases are same. If it's 1,000, the old one, the new one is 1,000. So it is the difference. So what the number of the years that we use here is, I'm gonna put it like years here, 0, 1, 2, 3, 4, and 5. Okay, so in here that means nothing, 0, 0, 0, 0. So there is no difference. So the idea about the replacement analysis is to get the incremental values, So if it was 1,000, it means 1,000 minus 1,000. So sales is not given here. Our job, our aim in this case is to find out whether it's worth to replace or not, with the purpose to prove, to give a confirmation, yes, we are saving in terms of the cost. And who remembers how much we will save it if we replace it with the new equipment?
6,000.
6,000, very good. So which means before we used to have 14,000, now we are reduced to 8,000. So we are saving by 6,000. So we're gonna have minus 6,000 for all years. We're gonna dollarize it. So one more time here. The amount that you're saving is 6,000. And depreciation, we remember that depreciation every year for the old equipment is a straight line, so which means that 1,000, 1,000, 1,000, 1,000, and so on for all years, and for the last 5 years remaining is 1,000. However, we're getting the incremental value in here, the difference between old and the new one. Old was 1,000, the new one is
500?
no. We are using according to markers. Wait a second. The values are given here for markers. Okay. Here. The first year, 7,920. So let me put it, make it like this, okay? Depreciation, old. Depreciation, new. Old, it's obvious, 1,000. I'm gonna dollarize it. And the old one is 7,920. It's given 10,080, 800. 3,600. And 1,680. I'm gonna dollarize it. Okay. And let me make it separate that. Okay. And replacement depreciation. Replacement depreciation. Okay, that's better, like this. So in here, the replacement depreciation, we are just getting the difference. This, oops. Now we're moving here. So this is depreciation that we got for this, okay, for replacement. And we're just closing it to calculate earnings before tax or operating income before tax. So the way to calculate is the same. Sales minus cash operating expenses and minus depreciation. 920, and we just drag it, okay. The tax is 40%. This times 0.40. So this is our tax saving. This is our tax saving. Now we can calculate after tax cash flow, operating cash flow, OCF after tax, and depreciation. So let me get the depreciation directly from here. And operating cash flow after tax equal to this, sorry, this minus this. As we can see here. And then we get final operating cash flow, cash flows after tax. But before calculating the final, but anyway, just operating cash flow. So after tax will be equal to okay, now we can calculate terminal non-operating cash flow. So before calculating the terminal non-operating cash flow, do you have any questions?
Can you show the formula for EBT?
Yes, sure. It is the same, exactly the same that we used to calculate, for expansion and the new product. But only the numbers that we get here is the replacement numbers.
Okay, thank you.
So the logic is here is that new minus old. Okay? And it is the same for all. For EBT, sorry, for cash operating expenses, for sales, and for depreciation. And total operating cash flow, if we refer to the slides, here. This is the formulation we use it. This is the formulation that we use it. So salvage value of new machine minus salvage value of old machine. Okay? Plus net working capital investment minus tax amount, salvage value of new machine minus book value of new machine, and minus salvage value of old machine minus book value of the old machine. So in here you're trying to tax for how much? was the salvage value and what was the book value, and the amount you gain. So your gain should be taxed. Your gain should be taxed. So this is the formulation we're using actually. So I'll put it down here. Salvage value for new machine, new, is $4,000. It says in the question that at the end of the 5th year, we'll be able to sell the new equipment for $4,000. This has been given as information. However, for all concerning the old one, at the end of the 15th year, you will get 0 market value from the old equipment. Okay, there's nothing you can get it when its project is done. So there's nothing we get it. There is no book value and directly 0. So which means the part of this equation, like sell old and BT old, is 0. This is 0. Okay. So this is thing that you should take into your mind while calculating the salvage value of the new equipment. And we know the change in net working capital was 3,000. So at the termination date, 4,000 plus 3,000 minus the tax amount. And the tax amount is 0.40 times for how much you are selling your new equipment. Your new equipment will be sold for 4,000. That 4,000 should be taxed, and that tax amount should be deducted. So this is what you used to do before. However, there is example when there is a old equipment and new equipment, they have some book value and salvage value at the end of the year, at the end of the termination date. So the calculation of the terminal non-operating cash flow will be a little bit different. We're going to have a lot of examples. Don't worry about it. A lot of examples. Now, this is our terminal operating cash flow. Now, we can calculate total operating cash flow after tax. So our investment cost, total investment cost is here. Our cash flows are here. However, with one difference in here, we're adding this terminal and operating cash flow. So this is what we got it for. And this was our aim, to calculate, to estimate these cash flows in order to find out whether our replacement of the old equipment with the new equipment will be profitable or not. We just run the, and we know the cost of capital is 11.5%. So NPV and IRR, NPV function, rate is 11.5%. The value is here, the range value. And we subtract the investment cost. We subtract the investment cost to calculate the NPV. As you can see, our NPV is not positive. And IRR before do I calculate the IRR, can you tell me when should I accept the project if you compare the IRR with the discount rate?
If IRR is higher than your cost.
Cost of capital, very true.
Yes.
Our cost of capital or discount rate is 11.5%. So we can see that our IRR is less than the cost of capital. Cost of capital is 11.5. So both investment criteria tells us that we should not accept the project. We should not replace the new equipment with the old one. We should just continue for the last 5 years. So if your decision was based on this analysis, then you should not replace your investment cost. You should not replace it. You should not replace the old equipment, because continuing with the old equipment, it will be more beneficial than just going with a new one, even though it saves like 6,000 per year. Do you have any questions? Please, if you don't have any questions, I'm going to move further. Feel free to ask. This I'm going to call replacements. Anyway, I'm going to call it as slides. Example from slides. And this is example from book. Okay, if you don't have any questions, that seems that everything is clear. That's perfect. Okay, I'm done with example with the slides. We can check the numbers. Yeah, the numbers are correct actually. You can do it manually, manual calculation like this. You can use this Excel spreadsheet, but I do strongly advise you to go with the Excel spreadsheet, because it gives you less probability of making any mistakes, and more efficiently you'll be able to calculate it. So decision, since the NPV is negative and the IRR is less than cost of capital, Michael should not replace the printer with a new copier. Okay, let me move to the example which is given in the book. Now, we are given here old equipment and the new equipment. You have old equipment, and this is the information which is given for the old equipment. Current book value is 400,000. Current market value is 600,000. Remaining life is 10 years. Annual sales 300,000. So annually you sell it for 300,000. Cash operating expenses 120,000. Annual depreciation 40,000. And expected salvage value 100,000. So at the end of the year of the termination, you will have this. However, you decided to replace with the new equipment. It can be any types of equipment, okay? So acquisition cost is 1 million. The life is 10 years. Annual sales 450. Look, now you're purchasing because of the cost saving, but because of you're purchasing for the sale, that the sale will be higher by 150,000 here. With the old one, you are able to produce 300, but with the new one, you're able to produce 450,000. But in terms of the cost, it's more expensive, like if you compare the expenses. Depreciation is even more expensive. So you're not saving any money in here, but you're gaining from the part of selling. And expected salvage value is more here as well. So we will apply the same logic with the expected salvage value. So what I'm going to do, I'm just going to copy this instead of just writing it from the beginning. Okay, I'm just copy it here. So my fixed investment in fixed capital is equal to 1 million. 1 million. I'm going to dollarize it and make it bigger. Okay, 1 million. Investment in net working capital was 80,000. It's given. in the book here. Salvage value of old equipment. Salvage value of old equipment. We are selling it for how much? Let us see it. You know the best thing what I can do here, to take it to the Excel spreadsheet and not returning back. Okay, great. Now can everybody see it? And now, great. So salvage value of all
100
equipment. Who can tell me how much?
100,000? No.
No. Of all the equipment, guys. Salvage value is for how much you're selling it now, not at the end of the 10th year. Okay, we're talking about the replacement, not the expansion.
600,000.
600,000. And now we need to tax. Book value, so salvage value old minus book value old. And it should be taxed the amount. So what we do, the tax rate is 30% times 600,000 minus book value 400,000. And investment outlay, we're using the same formula. 1 million plus change in net working capital minus salvage value plus the tax amount. Investment in fixed capital plus investment in net working capital minus salvage value of all equipment plus the tax amount that has been paid to government when you sell the new one. It's a difference between the salvage value and the book value of the old equipment. So this is our investment outlay. So this information, we got it. Okay. Now let me make it big, smaller. So number of the years we have here, 10 years. Okay. 0. Oops, sorry. There's somebody's writing something, but I'm 10 years. I'm going to come to the question.
Sorry, Professor.
Yes.
Ask one question.
Yes, please.
Where did we get the net working capital investment?
It's given. It's given in the book. It's given here. Like additional investment of 80,000 net working capital will be required.
Okay. Because I just saw it on the
Okay. Okay. In the table we don't have, but it's always given. It's always given. Okay. Now, for sales, it is simple. 450,000 minus 150,000. Sorry, 300,000. That would give us 150,000. And it's same for all years. Okay, same for all years. Coming to cash operating expenses, 150, 120. 150,000 minus 120,000, which is 30,000 incremental value. And depreciation old and depreciation new. The old one, where is it? I can't see it. 40,000. And the new one, 100,000. And incremental value, new minus old, as we do it always. Okay. I'm just making it smaller. And my EBT, earnings before tax, will be the following. So sales minus cost minus depreciation. This is my EBT. And it's same for all. Then it should be taxed by 40%. It should be taxed by 40% or 30. The tax rate is 30%, sorry. It's
Where did you get 40,000 for depreciation old?
just a second, I'm coming to that question. Where did I get this 40? This 40?
Yeah.
It's here. Annual depreciation, old equipment, it's here.
Oh, okay, thank you.
Can you see it clearly? If I make it bigger, I will not have a okay, like this.
Yeah, it's okay.
Operating cash flow after tax. So this minus this. And we're gonna put back the depreciation amount. So we're gonna add it back. Now, this is what we found operating cash flow after tax. Now we need to find terminal non-operating cash flow. Terminal non-operating cash flow. We need to be a bit careful in here. Okay. In here, to find, we're trying to find the salvage value. First of all, if you remember the formula of total non-operating cash flow is, let me just copy it from the book here. It's given.
Sorry, can I ask you?
Yes, sure, ask it.
Should we sum up or deduct operation cash flow after tax minus depreciation, not plus?
Wait, one more time. Sorry, I'm lost.
The last.
This one.
Yeah.
We should add the depreciation back to the operating cash flow after tax. We're always adding back the depreciation. Why we are adding? Because the depreciation is the non-cash item. And in estimation of the cash flow, you should always add back the depreciation. Why we are subtracting in here is purpose to have effect on the tax payment, to reduce the tax payment issue. Now, terminal non-operating cash flow is equal to salvage value plus change in net working capital and minus whatever you gain it, okay? This is how it works. Basically, this is the formula. So if you look to this one, well, we have it here, okay? Our expected salvage value is 200 and 100. So we are getting the just difference, new minus old, okay? We're getting just difference. 200,000 minus 100,000, but in the brackets. Plus change in net working capital, which is 80,000, minus 0.30 in the bracket that you have to calculate. how much money you earn. The money that you earn is here, 200 minus 100,000. Oops, sorry. So the difference, the incremental value that you are, because at the end of the year, the terminated value is equal to 100,000. And the amount that you're selling is this. Oops, sorry. 0.30 times, my gosh. And we close the bracket. Okay, it seems okay. But I think I forgot something. This 200,000. This 100,000. Okay. Okay. And we're putting to this one, to the last year. Okay, our total operating cash flows are equal to this, but with negative sign. And this 102. And with terminal operating cash flow. This is what we have been looking for so far. So cost of capital in here is equal to 8%. Cost of capital is 8%. It's 8%. NPV rate range and minus the investment cost. And IRR so our final decision on whether we should replace the old equipment with the new equipment is having the positive patterns, so which means that we should go with this project. And it is proved by two indicators, by two investment criteria, which is NPV and IRR. NPV, it's more than 0, it's having positive impact, so we say we accept our project. And IRR is more than cost of capital, and it has a positive direction that says, okay, you should accept the project in the case of replacement, the old one with the new equipment. Do you have any questions? Let me put it here. Okay. And let me save this one. Replacement cost project. Okay, and I'm going to okay. So I'm going to upload it. I'm going to put it to the Moodle, this example. We have so two examples, one example from slide, one example from the book. And we proceed on Wednesday. Next topics, okay? We'll have more topics. Do you have any questions?
Sorry, teacher, I
No.
have a question
Yes.
concerning next our first midterm. When
Huh.
do we have?
We're gonna discuss all together when we will have it on Wednesday. Okay, we'll discuss it on Wednesday.
Okay, I got it.
Okay, if you don't have any questions, I want to stop here today. Thank you so much, and see you on Wednesday.
Thank
Thank
you.
you. Goodbye.
Thank you, Professor.
Thank you.
Bye.
Bye.
Lecture. Thank you.
Thank you. Bye.
See you.
Bye.